Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. So I was a speaker at the Money Show last week, and I want to give you some of the highlights. The conference was overloaded about artificial intelligence, and generally my focus was when everybody's on one side of the boat, it's maybe time to move to the other side. So I did have a conversation with Steve Forbes. I thought it was really interesting, and I'll walk you through that a little bit. But his quote to me in parting was, "Patrick, keep some dry powder." We've got a new buy idea, Intel. Haven't bought Intel in a long time, but I think with how they're structuring the company, it makes a lot of sense, and think that the stock could move significantly over the long term. So the stock market reacted really positively to NVIDIA's earnings when it opened on Thursday. The market went up about 2%. NVIDIA went up quite a bit. For the week, the S&P was up approximately 1%. So the market's getting lofty. It's kind of running out of gas a little bit, in our opinion. We believe what's happening in this space, in the technology space, is that Microsoft wants to gobble up Google's market share. They want to go after search, change the dynamics of search with AI. So it's forcing everybody in that sector of the market to build out AI aggressively or be left behind. So we don't think AI is prime time yet. We think there's still a lot of work to do. So what we're wondering about is, will this year be the peak in that infrastructure spend? Obviously, this could go on for 5 or 10 years, but is this the real peak year as companies like Microsoft and Google, et cetera, really are forced to build out that infrastructure very quickly? We think the market's extended. Now, we talked about this a little bit last week. It's now over 13% above the 200-day. That's getting up there. It's not an all-time peak by any means, but it's consistent with other periods of the market where the market's run out of gas and has rolled over. Like what happened at the end of July of last year. You can see on our chart here, that was about 12.5% above the 200-day, and the market corrected on that. So we're thinking we're somewhere close to having a sizable correction. If not, then the market needs to rotate in a big way to things that have lagged. So the valuations are about 21 times earnings, and versus the bond market, the markets are way overvalued. So they've been at higher levels, but not too much higher. Again, this reminds me of 1987, where you got to a high level in February, but it continued to run for 5 more months before it ultimately came to a major correction in a day. So we'll have to see how this plays out, but we're setting up the cautionary signs at this point. Be on the lookout for a correction here probably in the near term. So the markets are significantly overbought. That overbought condition needs to be relieved. So this is kind of funny. Again, we really like Google. Google's a great company. They obviously will fix this, but when you use their AI product and search for achievements of white people, this shows the Pope. God doesn't look like the Pope, does it? Intel, in our opinion, is a long-term buy. You can see that it's pulled back from its high nicely. It's not cheap, but it's in our opinion, it's undervalued, as we think that the company will start to reaccelerate its growth. What they're doing, they're splitting off their contract manufacturing business into a separate entity owned by Intel, but it's separate. They have their own books. They have confidentiality of all their customer designs, so it's separated from Intel itself, and they're starting to pick up some nice business. So we think that this stock could go materially higher over the long term. Perhaps it comes down with the overall market when the market comes down, but we would be buyers now of a little bit, and then more aggressive buyers if the stock would come in. So on Thursday, we get a inflation reading from called PCE. This is the inflation that the Federal Reserve likes to look at out. This is the inflation that the Federal Reserve likes to look at in terms of an indicator. We think it's going to be on the high side of expectations, as CPI and PPI were higher than expected that were reported recently. So we think that the PCE will be a little bit hotter than expected. The PMI, which is the Purchasing Managers Index, is released on Friday. And this is a really good indicator for the overall economy. So what it measures is how purchasing managers see their business. So we think it'll come in again below 50. Below 50 is that it is contracting. Above 50, it's expanding. So we think again maybe many more months it'll stay below 50. So at this point, it should have turned positive. This is an unusually long period for it to be below 50 as a reading. You can see that it's been close to a year and a half now being below 50, which is very unusual. I just point out we like this as an indicator around 42. Tends to bottom out where the overall economy is in a recession and it starts to recover. It just really hasn't gotten bad enough yet. So the Money Show, we had a good discussion. We had a really good talk there. As I mentioned, the whole conference, the presentations I sat in on, it was very much about AI. There were some perma bulls there that everybody would recognize from the television, saying that we're in 1996. As you know, the tech bubble went up until basically early 2000. So we're early in the tech, this AI trend. I think it's more of a longer term story. I think it goes a good 10, 20 years. It's the real deal. I think this is the bubble year, could be the bubble year in terms of putting in the infrastructure. Then we're going to see a lot of software companies go public, a lot of money come into this. And I think it'll help a lot of industries in a big way reduce their cost structure. The S&P 500 has about 40% weighting in technology if you add back all the items that are really technology, like delivery, like Amazon, and other areas, like social media, like Google, Meta. If you add all that back into its weighting is about 40%, and that's really high. That's as high or higher than what it was in 1999 and 2000. So that's concerning to us that such a large area of the S&P and a much smaller part of the overall economy. So the two aren't matching up. So in our opinion, there's too much money in this AI sector, and we're likely to get some pullback in that whole sector. But we think it's a trend that people have to play longer term. Our message at the conference was, there's too many people on that side of the boat. Think about buying some blue chips, high quality, higher yielding stocks, loss averse tactical. We can do portfolios that are aggressive. If you have an AI portfolio, I can manage it using our tactical algorithm. So we can do that, but I think there is a fair amount of risk in the overall markets because of the overinflated part of the technology sector. So it was kind of interesting. I got a chance to sit down and talk to Steve Forbes a little bit, and I asked him what his opinion was as to, after having an inverted yield curve for roughly a year and a half now, usually it's much less time that we would roll over into a recession, maybe a year. What he thought was happening in the overall economy is real simple, that he thought the economy was being rebuilt from the COVID supply chain. And basically what he said to me was, Patrick, keep some dry powder. And our view is that probably by the middle part of this year, we could be going into a recession. I say could be. It's somewhere between now and the end of the year or early next year. but a recession is looming unless the Federal Reserve can cut rates quickly enough. So our opinion of what you want to do with your money is be defensive. Use my tactical loss versus strategies. I think that'll give you upside, but also protect your downside. Thank you very much. Please come to my website, Patrick Adams CFA. Sign up for Market in a Minute, and we'll send that to you every week. It includes some by email. It includes some really good statistical analysis of what's happening in the overall markets. Take care.